Hello, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 158, titled Rolling Weekly 10 Delta Put Options Prior to a Holiday Weekend. We're going to be using a real life example with Etsy Inc., which trades on the NASDAQ exchange under the ticker ETSY. So let's first get started by defining what is the 10 Delta weekly put strategy. Now, this is one of our ultra low risk strategies that we developed in 2020 involving weekly 10 Delta cash secured puts. Now, by using a 10 Delta strike, that means that there is a greater than 90% probability that the put options would not be exercised, or stated differently, will not expire in the money or with intrinsic value. So frequently when we sell our put options, what we also want to do in addition to generating income is to avoid exercise and having those shares put to us. Now, since the year 2020 to 21 represented an unusually low interest rate environment, annualized returns between 8 and 15% looked really, really good because the amount that we could generate with, let's say, CDs or money markets or treasuries were minuscule. Literally needed a magnifying glass to see any results. So that's one of the reasons we developed this strategy in the year 2020. Now, since our weekly contract obligations are for 5 days, Monday through Friday, if there is in fact a Monday holiday, that could cause a significant decline in that week's annualized returns. Now, this in fact is not a major big deal because Monday holidays only occurs a few times per calendar year. However, in this article, we will offer a solution with both pros and cons on circumnavigating this Monday holiday issue as it relates to this 10 Delta cash secured put strategy. Now, over the years, I have noticed and I have observed that rolling weekly put options on expiration Friday between the hours of 11 a.m. and 1 p.m., particularly Eastern time, of course, that the following Friday expiration will result in no significant change in our typical weekly returns, particularly when we annualize these returns. So if there's a Monday holiday, by rolling the current weekly options on Fridays between 11 a.m. and 1 p.m. to the following Friday, the annualized returns of those trades pretty much the same as if we had a full 5-day week. Now, every strategy approach will have a disadvantage. There's no free lunches out there. What is the downside to this approach? And that is pretty simple. We're going to be undertaking weekend risk. So if we go Monday to Friday, no weekend risk. If we go Friday to Friday, there will be one weekend of risk. So that is the trade-off. Are we willing to take that weekend risk in exchange for higher returns? Here's the real-life example now with Etsy. On August 30th, 21, two contracts of the 209.3 cash secured put were sold at 42 cents. So again, it's a 5-day trade, 8:30 to 9:03. Now, on expiration Friday, Etsy was trading at 220.38 at 1 p.m. Now, that 200 strike was out of the money, and we didn't really have to roll the option to avoid exercise, but to generate the kind of premium we were looking for, we decided to roll that option. So let's see how it turned out. The cost to close that 9.3200 put, which at 1 p.m. was slightly out of the money, was 4 cents. So $4 per contract, $8 for the two contracts. Now the 9/10, the following Friday, cash secured put expiration for the 202.50 put, which actually was a higher strike, so we're rolling out and up actually, and that had a delta of 9, or 0.9 per share, 9.90 for the contract. And you'll notice that the delta of puts is always with a negative symbol because they are inversely related to the price of the stock. So price of the stock goes up, put value goes down, and vice versa. Now that rolling that resulted in a premium of 47 cents. So the cost to close was 4 cents, and the premium was 47 cents on the 202.50 strike for the following Friday. And here you have a graphic representation, a screenshot taken directly from one of my brokerage accounts. For those of you who are also watching this podcast, it shows the cost to close of the 200 put was 4 cents, and the cash generated on the sale of the following Friday's 202.50 put was 47 cents. Now, if we took the annualized calculations for the first weekly put, where we generated 42 cents, now the cash required to secure that put was the strike price of 200 minus the premium of 42 cents. And then we'd multiply that by 52 to annualize it. It comes to 10.94% annualized. Now, remember, in this low interest rate environment that we had in 2020, that looked very, very good. And remember, there was a 90% plus probability that that the strike would expire out of the money, as it was for the first week here. Now, let's take a look at the annualized return for the rolling calculations for the 9/10 contract, the next Friday's contract expiration. And remember, that was for the 202.50 put. Well, the premium that we generated was 47 cents minus the 4 cents cost to close. So we divide that by the 202.50 strike minus the premium that we spent of 47 cents, and we multiply that by 52, and that came out to 11.07%. So 11.07 compared to 10.94, I mean, it's a wash. So by rolling that 200 put up to the 202.50 put on Friday to Friday resulted in an annualized return that was very similar. So let's summarize now. There was virtually no difference between the original annualized return and that of the rolling return, despite the fact that there would be one less day in that second contract cycle. Now, one trade, I hear you saying it right now, does not make a scientific study. But I've actually done this several dozen times with similar results. So you can actually do this by paper trading or just trade and see what happens. But this is the observation that I have had in, let's call it a non-scientific study, but something that's been pretty consistent over the couple of years that I've been doing this. Now, the advantage is higher returns for that 4-day week. That's the reason we're doing it. But the disadvantage or the trade-off is that we are incurring that weekend risk between the two contract cycles. Now, once again, since holiday weekends are usually quiet, I mean, a lot of the market makers are out of town and they're not involved with trading. It's usually quiet. The risk is limited, but it is there nonetheless. So these are all the parameters that we would have to accept if we decided to use this rolling strategy when there is a Monday holiday. Before I go, I'd like to mention to you folks our two best educational packages. I'll mention them briefly and then show you where you can get a lot more information on it. First, the BCI package, which has 18 components. And the 18th component actually has well over 200 components. So you'll get 6 online video courses with downloadable workbooks, detailed online courses, 6 calculators created by the blue-collar investor, found nowhere else, 5 of our best-selling books in ebook format, And that 18th component is our annual 13-month premium membership, which consists of 4 reports of eligible option selling securities, along with between 200 and 250 now training videos, and we add an additional one every single month. And also, our second of our best packages is the Trade Management Calculator package, and that includes our trade management spreadsheet, a one-of-a-kind spreadsheet that allows us to enter our trades, get initial calculations, adjust our trades with well over 20 exit strategy opportunities, and they get final results for each trade and for our total portfolios. That package also includes a 28-page user guide for the spreadsheet and my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. Where do you get information on this? Go to our website, thebluecollarinvestor.com. Click on the link at the top that says Best Discounted Packages. You can also get items individually in the bluecollarinvestor.com/store. Ladies and gentlemen, I want to thank you very, very much for taking the time to listen to, and some of you watch, this BCI podcast number 158. Rolling weekly 10 Delta put options prior to a holiday weekend. Folks, I hope you enjoyed this presentation, but more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.